Good morning. Today is Thursday, July 14th. It's Tom and me today. Sorry, I was absent yesterday. I'm still dealing with a issue with the United States Postal Service. So trying to figure that out. So anyway, but we'll start with inflation data. We have more inflation data today. Obviously, Tom and Andrew talked about the consumer price inflation data yesterday. Today, we're talking about producer prices. Estimate is for 10.7%, which would actually be a little bit of a decline from last time around. And that goes for the ex-food and energy and ex-food, energy, and trade. Tom, do we have the numbers where they come out yet?
Yes. So the year over year final demand PPI is 11.3% coming in, 0.6 higher than estimates at 10.7 and 0.5% higher than last month. The month over month, the survey was for 0.8. We came in at 1.1. This data is still filtering through here, but not great. The only indicator that maybe is down is the X food, X energy, X trade. Expectation was 6.6, but it came in at 6.4. So there is a little bit of a pullback there, but everything else appears to be.
What was X food and energy?
X food and energy was 8.2, which was in line with expectations and down 10 basis points from last month at 8.3.
Okay, so it's similar to what we were seeing in the CPI data, is that the headline coming in higher than expectations and an acceleration. The X food and energy coming in broadly in line, maybe a little bit higher than expectations, but marginal deceleration. And then if you exclude trade, then you're coming down even further. So I don't know. It's not a good report, but the CPI is kind of governing things right now. So let's spend a little bit of time on that and kind of talk about the postmortem on what happened with CPI. So Tom, yesterday the Fed was already pushing out some of its wheeling out some of its people to talk about what's going on with the interest rates and what they expect to do going forward. What did they say? And do you expect any change to the 75 basis point hike that we might have been thinking about yesterday?
So Raphael Bostic, the Atlanta Fed chief, basically came out at the interview was probably 1:30 yesterday afternoon, sometime in the afternoon. He said everything is in play, including a 100 basis point increase. And pretty much from the moment that happened, futures jumped significantly. So right now we're at a estimated number of hikes for the 27th of July is 3.7, up from 2.95 yesterday morning pre-CPI. So the expectation was maybe we'll do 3 yesterday, and now the expectation is we'll probably do 4. Bank of Canada also notably came out and raised 100 basis points yesterday on their funds rate. And so it's definitely, I would expect it to happen. I think the Fed is going to have to get more aggressive. We've been talking about it internally a little bit. If you look at the data in terms of how long it takes for an increase from the federal funds rate to really affect inflation, it's a really, really long lead time. So the more aggressive they are, perhaps the more swiftly you'll see an impact there. But I think we're finally starting to see a little bit of an impact. Particularly the jobs market from the initial rate hikes. But I think that, the next 6 to 8 months could be pretty choppy, particularly for those on the lower end of the economic scale. Also, Loretta Messer said anything less than 75 bips would be too little. I would definitely agree. If they do 75 bips, I think it's going to be interpreted as a weak move by the Fed. So right now we're looking at 8+ in terms of rate hikes, 7 of those in the next 2 months. It's going to get bumpy. It's going to get interesting. The question is, do you think we can actually hold a 4% federal funds rate through the end of the year and have a successful economy?
I don't think we do. And just to give you a little perspective, I did a lot of digging on this morning in terms of research in how monetary policy actually goes into and affects the economy and inflation itself. And what I found was that you're typically looking at the bulk of the move happening after about 2.5 to 3 years. And so 1 percentage point raise in interest rates, 100 basis points, 4 hikes in our parlance, that'll actually negatively impact inflation to the tune of about 0.8% over the course of 2.5 years. much of that impact happens between quarters 6 and 10. In other words, if you hike by 3 percentage points, then you're looking at about a 2.4% decrease in inflation. That 2.4% decrease in inflation is happening over the course of the following 2.5 to 3 years. And so ultimately what you're seeing is that the Federal Reserve is doing all this, but they're pushing on a string. They don't have the control of inflation, and it's going to take a long time for inflation to get down if it's solely reliant on the Federal Reserve. And what they're doing right now is especially hurting the economy. And so you're going to have the near-term economic drop. Inflation's going to take some time to come down. And the problem is the American consumer can't handle that at this point in time. We'll talk a little bit about where the consumer is right now. But it's not good. Savings rates continue to come down. And I'm concerned about where we're moving. We have average hourly earnings that were down 3.6%. That's an acceleration from being down 2.9% in the previous month. And the consumer can't handle many more months of this. We have an out. If we can get through the next 3 months and get that inflation down to 4 or 5%, then we could be getting through this. But the inflation just does not seem like it's going to come down all that quickly, especially if it's due to the Federal Reserve. The other piece is, inflation does seem to be peaking on its own, potentially. But again, it's not going to come down at all fast, and it's not solving the root cause that it's inflation is coming in faster, much faster than average hourly earnings. The Biden administration came out yesterday and released a prepared statement saying that, quote, while today's headline inflation reading is unacceptably high, it is also out of date, saying that energy alone comprised nearly half of the monthly increase in inflation. And today's data does not reflect the full impact of decreases in gasoline prices. And they said the core inflation came down for the third month in a row. The core inflation is still higher than the average hourly earnings. So we'd still be negative even on the core inflation. And that's actually accelerating because rent prices are going up. And so he's talking about a 4-pronged strategy to solve inflation. First is to bring down the price of gasoline, with SPR releases, putting a price cap on Russian oil, and accusing oil and gas companies of profiting by not passing along savings. That's number one, bring down the price of gas. Number two is ask Congress to reduce other costs like prescription drugs, utility bills, and health insurance premiums. I do not think that is feasible. Number three is oppose efforts by Republicans to raise taxes. That's not a change in anything. I don't think anyone really wants to raise taxes in this environment. So that's not any difference. And then number four is give the Fed the room it needs to combat inflation. And we already talked about the impotence of the Fed in the near term to control inflation. So the problem is the steps to solve inflation are weak. We're not solving the supply issue, and that's going to cause greater economic issues. And the more we see these higher inflation prints, the more the Federal Reserve wants to hike rates, but that's just going to drive the deeper recession. And maybe that's ultimately what the Fed wants. Tom, what are your thoughts on that?
I mean, I think there are just so many more obvious levers to pull. I think it's just a very odd tactic to take, saying that we need to antagonize the oil companies. We need to antagonize the healthcare companies. It's just not. I mean, healthcare, we talked about it yesterday, was one of the lowest levels of year-over-year inflation. It's actually not that. It's really not impacting at all. Healthcare costs are going up slower than almost anything else. I think they're up 4.8% year-over-year, which is half of the inflation rate. So I think that's just, it's paper tiger, right? Like your straw man argument. Oh, what do people hate? They hate oil companies. They hate big pharma. So let's just attack those guys. No one's going to get in line with us and say, hey, we hate the oil companies, we hate big pharma. But at the end of the day, it's not going to solve anything. What you really need to do is say, hey, we need to, protagonize the oil companies. How can we help you? How can we get more oil? How can we get the prices down? How can we work together to lower costs? And I think that the shocking thing is that, now is not the time to profit, when we literally released oil reserves from the special strategic oil reserve and then sold them to China rather than using them to lower costs here. I mean, it's finger pointing of the highest degree when you're literally profiting off of something that's supposed to be helping people and then saying, hey, we shouldn't profit off of this.
And then separately, the problem is we're seeing this data where the Fed is continually fighting the last war. The Federal Reserve is now reacting to inflation data. But again, that's not going to happen. It's not going to see the impact for that for 2 years. And instead, we're seeing market-based measures of inflation actually come down. The market is actually pricing in a rate cut as soon as February. U.S. break-evens, if you look at the TIPS market, those have come down substantially. The 2-year break-even now on inflation is 2.96%. That's down from over 4% just a month ago, and from almost 5% in March. The 10-year break-even is down to 2.3%. That's down from over 2.6% in June and 3% in April. And at the end of the day, the Fed is just fighting the last war. And the problem is, I think that they are potentially on the cusp of one of the biggest monetary policy mistakes in the history of the United States. They're hiking into a recession. And at this point in time, all else equal, if we had a neutral policy stance right now, we'd be cutting rates. We should be cutting rates. And they're just going to hike, and they're going to hike even faster. Tom, what's your number? What do you think they'll hike by, if any?
I think they'll do 1%, if I had to guess. Even though the futures chart shows that they're going to hike basically 8 to 8.5, 9 times in the next 4 or 5 months, in February, the futures are indicating they're going to cut. So I think the play with the fat part of the bell curve right now is that the Fed accelerates the rate at which they're hiking rates. The economy slows to a halt. Unemployment spikes significantly. There are lots and lots of layoffs, particularly in white collar spaces. Some of these administrative jobs. If you're not actively producing a product or a service, you're on the chopping block. Almost to the point where it's merit based or not. You could be out very quickly. And I think that at that point, they're going to have to be playing catch up. We're going to be going right back to quantitative easing, rate cuts, because they're going to have to turn around and make monetary policy as loose as possible in order to bring the economy back out of the abyss that they're about to push us into. And even that probably will take some time to, if rate hikes take, 6 to 8 quarters, rate cuts also take time. So I think we're just going to be riding a roller coaster for the next 2 or 3 years. But I think that, honestly, we're going to be receding. We're going to be in a recession probably for, I would say, at least the next year and a half. I think it's going to be a pretty deep, pretty rough recession, but I don't think it's going to be 2008. I think the market's taking a lot of the froth off the top. I don't think necessarily that means we're going to go down another 40%, but I think that the everyday American is going to feel a lot more stressed financially for the foreseeable future as a result of this current situation. Yeah.
So Tom's saying 100 basis points. I would say 75 basis points, just because I don't think the Fed is that creative. I think the really interesting thing would be, what if they raise by 50? And I think that, I don't think that they're going to do that, but potentially, if they want to say, we get it, we were behind the curve, but we have to now shift that. We have to get on the right side of the boat.
Yeah.
Because right now we're just getting rocked back and forth. We have to get on the right side of the boat. That means fighting the next war, not the last war. And that means being proactive than rather reactive. If I was them, I would not hike rates at all. And instead, I'd call up Joe Biden. I'd call up Janet Yellen. I'd call up Jennifer Granholm, the energy secretary. And I'd say, we got to figure out the supply issue. And we have to do that yesterday. And I don't know why we haven't done that yet, but the Federal Reserve can't control that. And if you're not careful, you're going to force us to create one of the more significant recessions. Right now, we're not there. We still have some savings, but every month that goes by is another month that people lose money in real dollar terms. And that needs to get solved. So initial jobless claims, where were we, Tom, this week?
So we came in slightly above expectations. The survey was for 235,000 initial jobless claims. We came in at 244. So again,
244.
244. Yeah, wow. So we were up about 9,000 jobs. Also notably, the continuing claims, the expectation was for 13.8 million, and that actually contracted by about It came in at 13.31 million open jobs. So we saw quite a bit of contraction there. We also saw the prior month reading on open jobs claims contract as well by about 30,000 jobs. So the jobs that were out there and posted, those are getting culled. Notably, for those who were at the macro the other day, we talked about, the layoffs in the tech industry. My brother working at OneTrust and the big layoffs there, and that we saw some notable changes. But Meta, I have an inside track on someone who was currently interviewing at Meta, and basically they said, thanks for interviewing with us. We're freezing until 2023. We're going to keep you on file. You'll be the first person to be continuing to interview in January. And if we're being realistic, I don't think they're going to be hiring in January either.
Yeah. Taiwan Semiconductor was talking about excess inventory in the supply chain. They reported earnings today, which are actually very good, led by high performance computing and Internet of Things. Smartphone was weak, though. They do see a softening consumer. There's excess inventory on the consumer type businesses, smartphones, PCs, consumer end markets. Supply chain is already taking action on that. In terms of data center and automotive, that continues to actually be strong. So Taiwan Semi actually hanging in there is up 2%, but on these results, I would have thought it would be up 10. I mean, they were phenomenal numbers, but going into a down cycle on semiconductors is tough for Taiwan Semi. JP Morgan also reported earnings this morning. EPS was broadly in line once you back out some of the one-time items. The big picture on JP Morgan is they're being very conservative. They stopped all share buybacks. They're really conserving their cash balances. The trading business was fine. The investment banking business was pretty much non-existent, and that went for Morgan Stanley as well. Morgan Stanley also reported earnings this morning, basically a non-existent investment banking business. Net interest income actually performed well, but they're conservative, and JP Morgan definitely aware of some of the headwinds in the economy right now. Tomorrow we get retail sales. That'll come out at 8:30 in the morning. That'll be the last big game changer for Q2 GDP because that's a June data number. And the estimate is for 0.9% growth on a month over month basis. Even if you exclude auto and gas, you're still looking at 0.1% growth. I think that's a little bit aggressive. I don't think that the retail sales will come in all that strong unless it's inflation. But again, that's a nominal number. That's retail sales nominally. 0.1% month over month equates to about 1.3% on an annualized basis. And so obviously that's a lot less than the 9% inflation. Retail is pulling back, and it's pulling back in a big way. And there's implications for that. So with that, Tom, anything to add?
Be safe out there, everybody.
All right.
Good luck and Godspeed.